Watching the wheel turn. There we go. We're good.
Okay. So I'd like to welcome everybody here today to the Upper Thames River Conservation Authority Finance and Audit Committee meeting. Today is September the 28th. December will be coming all too soon. So first item we have is approval of the agenda. Can I get somebody to move the approval of the agenda as presented?
So moved.
So seconded.
Brian's moving that, and I heard Anna Marie second that. Any comments or questions all on the motion to approve the agenda? If not, I'll call for the vote, and I'll get Michelle to do the roll. And I guess this should be the roll for attendance as well. I neglected to do that. So Michelle, if you could do that, please.
Alan Dale,
I'm present and I vote yes.
Anna Marie Murray,
Yes.
Brian Petrie,
Yes on both accounts.
and Jim Russell,
Yes and yes.
and Sandy Levin has sent his regrets.
Yes, he did. So thank you. We have 4 committee members present, and the motion to approve the agenda has been carried. Thank you. Any declarations of conflict or interest today from any of the committee members? I'm not seeing or hearing anything. Item number 3 is the minutes of the previous meeting. That was on July the 9th, and Michelle circulated those minutes with our agenda package. Can I get somebody to move the adoption of the minutes?
I'll move those.
Jim's going to move them. Seconder?
I can second that.
Brian, thank you. Okay. There's the minutes there up on the screen. Does anybody have any comments or questions at all on the minutes from July the 9th? I'm not seeing or hearing anything, so I'll call for the vote. And Michelle, if you could do the roll, please.
Oh, Mr. Chair, I'm going to pull my
Sorry, go ahead, Brian.
I'm going to pull my second because I was not there at the meeting, so I don't think it's proper that I second that.
Oh, okay. Anna Marie, would you like to second the minutes?
Yes,
from the
I
last
would.
meeting? Okay,
Yes.
Thank you very much. Appreciate that. So we have Jim moving the motion to approve the minutes and Anna Marie to second that. Okay, any other comments or questions all on the minutes? Seeing or hearing nothing, then I'm going to call for the vote. So Michelle, if you could, please.
Alan Dale,
Yes.
Anna Marie Murray,
Yes.
Brian Petrie,
Yes.
Jim Russell,
Yes.
Okay, so that's carried. Thank you. Item number 4 on the agenda is a presentation from Phillips, Hager, and North, and I believe that's going to be at 11:30. That those folks are going to join us at. So this takes us down to item number 5, which is a closed session. So can I have a mover for us to go into closed session?
So moved.
Moved by Anna Marie. Somebody like to second
Seconded.
that, please? I think that was Brian that seconded that.
Yes.
Okay. Any comments or questions at all on the motion to go into closed session? I'm not seeing or hearing anything, so I'll call for the vote. And Michelle, if you could do the roll, please.
Alan Dale,
Yes?
Anna Marie Murray,
Yes.
Brian Petrie,
Yes.
Jim Russell.
Yes.
Okay, that's carried.
There we go. We're up live now.
Okay.
No, we'll be in touch, and yeah, we'll do that shortly.
Terrific.
And,
Okay.
Thanks for everybody for doing this. Sorry it went on a little longer, and look forward to working with you.
No, that's really good. We appreciate it. We appreciate you taking the time to meet with us today. Before you go, I'll just get a motion then from the committee to receive your letter, the letter of engagement and the audit plan letter. Would somebody like to move that, please?
Also move.
Anna Marie's going to move that. The seconder,
I'll second that.
seconded by Jim. Any comments or questions at all on those items?
I had a
If
question.
not- oh,
Sorry, I just,
go ahead.
do we vote to receive it or approve it? Or does it get approved at the full board level? I don't know.
Michelle, can you help me out on the wording there? What
Uh,
we
in-
traditionally do?
Traditionally, the committee just receives the plan.
Okay. All right.
Okay, well, if that works for everyone, that's what we'll do as we normally have done. Okay.
Just a question on the motion.
Yep.
Can we just receive the presentation by Seebach and Company? Which we, that way we don't have to specifically, I guess we're not releasing the actual presentation itself public, but
Are we okay that way, Michelle? Or are we still?
I believe so. It's kind of up to you guys.
my only issue with the current motion is that it specifically says those two items.
Okay, well, if it just to make it.
I would just like to receive, personally, I'd just like to see the presentation by by Seebach and Company as information.
Okay. If that's
If that's amendable through the mover and seconder.
That's a good
Materials.
idea, Brian. Thank you. I agree.
Materials are certainly confidential, so we'll do everything we can to keep it that way. Good. Okay, so Anna Marie's good with that. Jim, you were the seconder.
Yes, no, that's a friendly amendment. That's good.
Okay, good, good. Thank you. Thanks, Brian. If everyone's okay, I'll call for the vote then. Michelle, could you do the roll, please?
Alan Dale,
Yes.
Anna Marie Murray,
Yes.
Brian Petrie,
Yes.
Jim Raffle.
Yes.
Okay, that's carried. Thank you very much. And again, thank you. Appreciate everyone's attendance and appreciate the presentation.
No, thank you very much.
Thank you. Have a good day.
Yeah, you too. Bye.
Okay, so that takes us, we still have item number 4, which is a presentation from Phillips, Hager, and North.
They are in the waiting room, so I just was waiting for the okay, and I'll let them in.
Okay,
I did
Sounds
message
good.
them and tell them we would let them in shortly. So,
all right.
okay, so I'll let them in now.
Hello?
Oh, there we go. We've got Layla here.
Yes, hi.
Hello, how are you doing today?
Good, how are you? I think
Good,
my
thanks.
camera is not working. Let me just fix my camera here. I just realized my camera's not working. Sorry.
Okay.
Hopefully it should work soon. Okay, there we are.
Oh, there's Layla. Good morning. I guess good afternoon. We're after lunch now.
That's right.
No, we're not actually. Gee, we're still 10 to 12. My apologies. I thought we were right at noon hour here, but
So did I actually. Time flies.
yes, no doubt. Okay, so welcome, Layla. Appreciate
Thank
you
you.
taking the time to meet with us today. And
you.
I'm going to turn it over to you and let you do your presentation.
Great, thank you. Do you hear me okay? Is everything fine with the connection?
All seems to be good.
Great. And I think I have my colleague Jacinta who's joining. Jacinta, are you there?
I'm here. Hi, everybody.
Okay. Hi. So thank you, everyone, for inviting us in to present. I understood that I don't have a ton of time. How much time do I have, Christine?
Well, you have what you need because
Okay.
well, you've prepared a report, and the real question is, are we okay to make a change from the Canadian, so much Canadian equity to something else?
Mm-hmm.
And your report speaks to bonds and real estate and a bunch of other things. So
Yes.
Explaining what's in your report for the committee, I think is important.
Of course, yeah, I'll try to keep it to 20 minutes
Yeah.
to allow time for Q&A. And if I could share my screen, I'm not allowed to share it right now because I think somebody else is.
Yep, I will fix that. Just give me 1 second here.
Okay, great.
And then I think I have to change one more setting. Who can share? All participants. Okay, I think you should be okay now. Try it and let me know if it works.
Great. Yeah, I am gonna close the presentation accidentally as these things go, so I'm gonna have to reopen it again. There we are. Hold on, sorry, is it still? Yes. Okay, all right. I'm gonna give this another try. Share screen, window, UTRCA. All right. Okay, does everybody see my screen?
Yes.
Yes.
Okay, great. Well, first of all, thank you very much for having us in to present today. I wanted to provide a short overview of performance, which has been great. So I'm not going to spend too much time on it and then go into the recommendations. So just to set the stage actually for our recommendations, especially as they relate to bonds, I wanted to quickly take a few minutes to talk about what our outlook is for the bond markets, because this is really important for all of our clients that have a substantial amount of bonds in their portfolios, as you do. So as you see on page 4, what we've shown is effectively the tapering program that is expected to happen in Canada. What you see on the right-hand side on the left-hand side of the page is the growth in Bank of Canada's balance sheet. If you may recall, last March the governments intervened significantly, not just in Canada but across the globe, to keep the financial markets afloat and prevent what was really a health crisis from turning into a financial crisis. On the right-hand side of the page, you can see this program of monetary easing was substantially facilitated by Bank of Canada purchasing bonds that were issued by the Government of Canada. So Government of Canada started to issue a lot of bonds to lubricate the economy. Bank of Canada purchased about 95% of those bonds in fiscal year 2021, and as a result, a lot of money was released into the system. A few months ago, Bank of Canada announced its tapering program. What that means is going to reduce their bond purchasing program. However, not by a lot. You can see on the extreme right-hand side of the page, our estimation is that the bond buying program is going to be reduced, but it's still going to be about 75% of the Government of Canada new issuance. So certainly reducing monetary easing, but to a lesser extent. More recently, just last week, the Federal Reserve signaled tapering, and they said that if everything stays the same, they'll start around November. And just to be very clear, tapering, which is reducing the bond buying program, is different from rising interest rates. And the Federal Reserve has gone into extreme pain to separate the two events. So they did say they will start tapering earlier, and then if things go well, they'll start to look at raising rates probably sometime next year. So a lot of our clients have asked us, what does it mean when the tapering program starts? What impact does it have on the stock markets, which is of great concern to most of our clients? So what we did was we looked past to the equity markets, and you can see on page 5 S&P 500 and how it has really grown. I mean, there have been periods of decline, but it has really grown overall throughout the quantitative easing tapering of previous periods. And on the table on the right-hand side, you can see we've highlighted periods in which the quantitative easing was terminated, and there were various periods of termination and reduction, etc., or discussion. And you can see that immediately after each announcement, the market was, sometimes they shrugged it off, sometimes it had a decline. But really, when you look at the longer term, which is what is really most relevant to our clients, because most of them have a long time horizon like yours, you can see that the markets kept going and shrugged off the effect of that completely. So the good news in all of this is that, don't forget that tapering was really a sign that the economic activity is going on robustly. And if you have robust economic activity, that tapering shouldn't really make a huge impact, or at all any impact on the stock markets over the long term, as we have seen. The last thing I wanted to talk to you about yields, which goes directly to one of our recommendations, is that, again, another question that we're getting from our clients is, as we're seeing more normalization of the bond markets and the interest rate environment on the horizon, and I'm not suggesting it's going to be in the next few months, it's probably going to be in the next couple of years, what is our estimate for a normal level of interest rates? Where do we think yields are going to settle? And not an easy question to answer, but really, when we think of bond yields, so when we think of a 10-year Government of Canada bond, for example, a nominal yield has two components. One component is the inflation component, and the other component is what is called the real yield component, which is the real cost of borrowing after inflation. And you marry those two, you marry the inflation and the real yield together, you get the nominal yield. So inflation right now, obviously quite high, higher than we've experienced before, but we have said quite consistently, and you would have seen this in our communication, that we believe this higher inflation is transitory. We believe it is going to mean revert to somewhere around 2%. So we think that the inflation component is going to eventually settle somewhere around 2%, probably in the next 2 to 3 years. On the real yield side, there has been a consistent secular decline in real yields, or in real cost of borrowing worldwide. And in fact, the Bank of England did a paper on this in 2016, where they looked at countries around the world. Doesn't matter if they were developed or emerging countries, didn't matter if the governments were dictatorships or democracies. The pattern of decline in the real cost of borrowing was consistent in their research. And that has been largely attributed to declining family sizes. So as the rate of population growth has declined, inflation has subsided in a lot of these countries, and we have seen the real rates along with it have subsided as well. So we do think that real rates today, they're actually negative, where we have real rates in Canada that are negative. In the US, they're negative. In Europe, they've been negative for even longer. So we think that once we see some rate rises from the government, real yields probably not going to be negative, but they're probably going to settle somewhere around 30 basis points, which is a really, really low level. So if you marry, 2% inflation with 30 basis point real cost of borrowing, you're going to arrive at somewhere between 2 to 3% for 10-year Government of Canada bond. And that really, I think, sends a message to many of our clients that when things normalize, we are not going to go back to an environment of 4, 5, 6% return or income that we saw from bonds. We're probably going to be at around 2 to 3%. So with that, I'll just go into the portfolio performance quickly. What you see on page 7 is a summary of the portfolio market values, just over 7.1 million. And below it, you see performance. So as a reminder, portfolio inception was in 2018. It was in the spring of 2018. And the numbers that you see on the page, anything more than 1 year is annualized. So the 3-year annualized number means that over a 3-year period, on average, the portfolio has had a return of about 11% since inception on an annualized basis. Again, every year on average, portfolio return has been about 11%. Last year was a great year for most of our clients, a return of 19% from the portfolio, and even the past 3 months, quite robust performance of 7%, which, if you ask us what is our long-term outlook for equities on an annualized basis, we would tell you it's between 7 to 8%. So the fact that we are getting that in a 3-month period, again, highlights the strength of the reopening and how robust the economic recovery has been. We are active managers. So for anyone who's new to the committee, we are active managers. So it is important to us that we are able to generate value in our clients' portfolios over the long term. And by generating value, I mean doing better than the benchmark has done. So for each of our clients, we set up a custom benchmark that fully reflects the portfolio asset allocation. And you can see the custom benchmark for your portfolio footnoted at the bottom. And if you compare it to your investment policy statement, you'll see that it's the exact same asset allocation. So I'm happy to say that in the difference line, you can see over the various time periods, we have managed to add substantial value to the portfolio. So we've managed to do better than the benchmarks. The numbers that you see on the page are gross of fees. When benchmark comparisons used, always gross of fee numbers are used, but we always footnote fees on the page. So you can see the last line on the page has fees footnoted at 60 basis points. So if you subtract 60 basis points from the difference line, again, over the long term, we've managed to still add substantial value add. On page 8 is a snapshot of the portfolio allocations. The pie chart shows sort of the strategy allocation, and then the table shows what the target allocations are. So overall, what you will see if you add up the numbers on a pie chart, and I'm sorry, we meant to add a column there to actually make this easier to read for you, and we did not. We will do it next time. But the morale of the story is that we are underweight, slightly underweight bonds by about 2 to 3%. And we're slightly overweight equities to the same amount, and that is by design. Our the tactical asset allocation directive from a chief investment officer has been to underweight bonds for the past year and a half, and that has been with a view of better valuation opportunities being available from equities in view of the robust economic recovery and also in view of bond yields being at historic low levels and potentially rising, rising interest rates, of course, lead to a decline in bond prices, so they can lead to capital loss in client portfolios. So with a view to that, we are overweight equities because we think there are better relative return opportunities to be had there. So maybe I'll pause there just to see if there are any questions before I go into our recommendations.
Anybody have any questions? Go ahead, Brian.
Thank you. I do have one. Again, this was passed on through Sandy. It says, hello, note 7, a note on page 7 of her presentation, all performance is shown gross of investment management and custody fees of 60 basis points per annum. Does that mean the 3-year actual return is 10.9 minus 0.60, or is it 10.9 minus 6.0 times 3?
6.0 times 3? No, sorry. So the 3-year return, for example, on an annualized basis, if we were to take out fees, would be 10.3%. Does that answer the question?
Okay, yes, it does. Okay.
Yeah, because I see what you mean by times 3. No, because the 10.9 is annualized, so it's average annual return. It's not cumulative return. That's why you don't multiply by 3.
Okay, that was that question. And also, it does ask that if we find out either before or after the meeting, if that's possible, get the numbers in net and not gross.
Yeah, so what we can do is we can add a line that shows post-fee returns. We have to, for custom benchmark performance comparison, we always show gross, but we can add a line below the difference line that shows the net performance.
That would be appreciated, I think.
Jacinta, would you mind making a note of that on the presentation template for next time?
Of course.
Thanks.
Any other questions at this point? Not seeing or hearing anything else, so carry on, Layla.
Great. So, you know what, I'm going to skip a few slides just to leave time for portfolio recommendations. So I wanted to bring 2 portfolio recommendations to the committee's attention. Both of them would require a change in your investment policy statement. One of them would lead to a slight increase in fees. So I wanted to put those two things right up front, so you are aware of them and you can take my comments in that context. So the first recommendation is to reduce Canadian equities, take 5% from Canadian equities. And the second recommendation is to reduce bonds by 5%. What you can see on page 15 is a side-by-side comparison of the current portfolio that we manage for you, the target asset mixes, and what we're proposing you move to. So on the left-hand side, you can see the current portfolio. It has about 25% in Canadian equities, and it has a total of 40% in bonds. And on the right-hand side, and you can see that we've put a red circle around Canadian equities and a red circle around global bonds. And what you see on the right-hand side is that we've done a couple of things. You can see Canadian equities is now 20%. It's not 25%. So we've taken 5% off there. Bonds are now 35%. We've taken out the global bond allocation. So those are the 2 things that are missing on the right-hand side. But then what is being added, which is the green circles is we're effectively taking that 10% that we're taking off from a combination of Canadian equities and bonds and putting it in our real estate strategy. That's number one. And number two, we're making a slight change to the universe bond allocation to change it. We're not changing the amount of the universe bond allocation. We're suggesting changing it to our core plus bond strategy that uses more plus strategies. And effectively what we're doing is we're saying, okay, if you're reducing bonds by 5% by taking out global bonds, what else can we do in the bond portfolio to get some of that exposure back, but in a different way? So of the two things that you see on the right-hand side of the page, so changing universe fixed income to core plus bonds and then adding real estate, the one that leads to a fee increase is adding real estate. And I'll speak to that in a moment. So maybe before I stop for questions, I'll just quickly go through what these changes are. So before I do that, the rationale for reducing Canadian equities, and just so you know, structurally your portfolio, tactically your portfolio has been underweight Canadian equities for the past year. That has been by design. Any of our clients that had more than 20% in Canadian equities, we actually reduced it to somewhere around 20 to 21% tactically. And the reason for that is Canadian equities are quite cyclical. So they would have done, you know that Canadian equities would have done very, very well coming out. So sort of at around November onwards, they did really well. But before that, they did nothing. And in fact, they barely eked out a positive return for the year end of 2020, again, because they're very cyclical. So they didn't have the diversification to benefit from a lot of the economic reopening that we actually saw happen globally in summer and fall of last year. And the thing about cyclical sectors also is that, you know, once you get that sort of bounce, that cyclical bounce, you would expect it to sort of taper off. So we expect Canadian equities to continue to do well, but it is unlikely that they're going to maintain the same momentum they had before, again, because they are quite cyclical. They don't have the same diversification. And another thing with Canadian equities, you know, the energy sector from a secular standpoint continues to be challenged. And I know oil is now $80 a barrel, so certainly it's okay now, but we do believe there are significant secular challenges that are facing the oil patch, and we're seeing that with a lot of the oil patch companies not reinvesting as much into the existing operations. And we also think that there might be a bit of an overhang on Canadian banks, because with the re-election of the Liberal government, they were the only political party that talked about imposing a tax on banks. And the impact's going to be marginal. We don't think it's going to. We think it's going to shave off maybe 2% off earnings, which is not significant, but it is just the investor scrutiny of the bank stocks, which might impact valuation. So that is why overall we're recommending reducing Canadian equities by 5% from 25 to 20%. When it comes to changing universe bonds with core plus to core plus bonds, what I've shown on page 16, and I'll start with page 16. What I've shown on page 16 is a side-by-side comparison of what is in our core plus bond fund, and really what is in the universe bond index, the Canadian investment grade bond index, which is the benchmark. So the benchmark is the yellow lines, and the core plus bond fund is the blue lines. So what you have currently in your portfolio in universe bonds really reflects the benchmark. You have Government of Canada bonds, you have federal agency and provincial bonds, and you have investment grade corporate bonds. And that's all fine, but now that we're reducing a little bit from fixed income, we want to provide a bit of a tailwind to performance in fixed income. And that is why we're recommending you consider Core Plus, where you can see at the right-hand side of the page, it adds strategies tactically to the portfolio that are not part of the Canadian investment grade universe. So it has some exposure to mortgages, it has some exposure to high yield bonds, and some exposure to emerging market debt. So it's effectively a bit of a go anywhere, do anything strategy that is highly tactically managed. And the highly tactical, that has resulted, if you look at the table at the bottom of the page, higher yield than the universe benchmark. So you can see that the Core Plus Bond Fund has a yield of 2.2, which is much higher than 1.7 you get from our investment grade benchmark. And you know, in this environment where you are getting less than 1% on short-term bonds and barely 1.5% from long-term bonds, 50 basis points difference really does matter. And that's why we are emphasizing to a lot of our clients to move towards a Core Plus approach. And for any clients that are concerned, and I'm sure there are clients out there who are concerned about us sort of swinging for the fences and buying too much emerging market debt, on page 17, we've shown really how tactically this fund is managed, and we've shown how it's being managed through three different sort of crises periods, if you will, in the past. And I'll focus on the COVID pandemic, where you can see going into the pandemic, we had a lot of federal bonds in cash, and that was just dry powder in the portfolio because we felt the bond market was a little bit frothy going into the pandemic. You know, I would say in early March of 2020. Valuations in the corporate sector were a little bit stretched, and that meant that we had very little high yield, very little emerging market debt. You can see that on that page, and much more federal bonds and cash. So that was our dry powder as soon as dislocations in the bond markets happened when the pandemic hit. And dislocations will always happen. You just have to wait for them to happen. And we knew it would happen at some point. We didn't know when, but as soon as those dislocations happened, we were able to really deploy that dry powder and buy high yield bonds and emerging market debt at valuations that were substantially below what we had seen in more recent memory. And of course, as the reopening started and things started to improve, we took some of that profit off the table. So you can see that at its peak, the high yield bonds reached about 10%, and today they're lower. They're somewhere around 7%. And same with emerging market debt, they're now lower allocations. So I wanted to provide this comfort for the committee that although we're moving to a bit of a different strategy and it has some tactical levers, it is still quite conservatively managed to make sure that we are defensive, just as defensive as what we would have been in your portfolio originally when it is merited to be defensive. But we now have the levers to take advantage of dislocations to add value going forward. And the Core Plus Bond Fund did phenomenally well, and it continues to do phenomenally well, again, because of taking advantage of these opportunities. Maybe I'll pause there before I go into real estate and see if there are any questions.
Anybody have any questions then on that part of the plan? Christine, go ahead.
I do. Just a question about the difference between the universe bonds and the Core Plus. Is there any great difference in geography between the two funds?
It's not a great difference. It is a slight difference. And I think the best way to explain it is maybe on this page. So if you look on this page, everything that is orange at the top, light blue provincial bonds, dark blue investment grade corporate bonds, and green mortgages, that's all Canada. And that would all be represented in your current portfolio. The only difference is high yield bonds and emerging market debt. Okay. So brown at the bottom and orange at the bottom, and those are much smaller allocations. So yeah, it goes outside Canada while you currently don't go outside Canada, but not by much.
Not by much, you're right. Okay, thank you.
Yeah.
Okay, thanks. Brian, you had a question?
Yeah, so we did talk about, you mentioned there were higher fees. Can you explain the fee difference between the Core Plus and the Universe bonds?
Oh, so there is no fee. Actually, switching from your current Universe bonds to Core Plus doesn't lead to a fee difference. The fee difference only kicks in when we introduce real estate. So this switch doesn't have a fee ramification.
Okay, and just to clarify, you're recommending the switch to Core Plus bonds because if we did switch, we'd be losing global bonds, and so this would give us some global market bonds.
Yes, exactly. Precisely. So you're losing 5% of your global market exposure. You're not getting 5% back here, but you're getting a little bit of it back.
And one last, what's the difference between the Core Plus bond return and our current Universe bonds?
So your current Universe bonds only have the yellows. On page 16, you can see the yellow bars. Those are the only ones that are represented. So it's all Canadian, all only investment grade in your current Universe bond allocation. So the Core Plus adds those extra 3 bonds, right? Sorry?
Sorry, no, you have the Core Plus bond yield return at the bottom of the page 16, but we don't have the current yield.
Yeah, I have it in the back. Sorry, just a second. Yeah, so the total return bond fund has a yield of 1.8. So the total return bond fund is what is in your portfolio today, and the yield is only 1.8%. So Core Plus gives you 40 basis points more than what you have now.
Okay.
Does that make sense?
Yeah.
Yep. So a slight increase there, and of course, yeah, the fees are the same. So. Okay.
The fees are the same. I that's why I think, you know, I think it's certainly something that makes sense from a recommendation standpoint for you to consider, given that. Yeah.
Why leave the sell the global bonds that we already have?
Oh, just because we wanted to reduce, so we're talking to any of our clients that have a long time horizon like you. Maybe I'll go back to this chart actually. So we're talking to all of our clients that have more than 35% in bonds and a long time horizon. And just in view of what's happening in the bond markets, we're recommending that they reduce some of their bond allocation for a majority of them in favor of real estate, and in your case as well, in favor of real estate. It just makes sense. Real estate has characteristics of both bonds and equities, which is why we're taking 5% from Canada, 5% from Canadian bonds and merging them into real estate. You get a higher cash yield than you get for bonds. Cash yield for real estate is about 3 to 4%. It's about 3.2 right now. But the target cash yield is between 3 to 4%. And you also get some, of course, you get the capital appreciation in line with growth in GDP and growth in inflation. So the rationale is really, look, if we were in a normalized interest rate environment, we'd probably let you sort of not really proactively try to change your bond allocation. But just given where yields are now and that they're rising, we think it makes sense for clients to take a little bit off bonds and put it somewhere else.
Okay. And what was our yield off the global bonds that we have?
Oh, Jacinta, do we have that in the back? I don't think we do. Jacinta, I'm sorry, we don't have that slide in the back, but Jacinta can look it up for you.
Okay,
I
thank
can
you.
definitely do that. And the global bond holdings would be through the high yield bonds that are held in the portfolio,
Yes,
right?
Yes. So you have a global bond target. Yes, it is through the high yield. So you have a global bond target, and the global bond portfolio was mostly sovereign bonds. So we actually switched that out when yields came out, when yields were quite low back in March. And we switched it into high yield to take advantage of the dislocation in the high yield bond market. So the yield from global bonds is not really existent in your portfolio. It's the high yield bond yield that's existent in your portfolio. And that high yield bond is, it's 3.1%. So right now the portfolio has 10% in high yield and yield is 3.1%. You see that? Oh, sorry, it's on this page.
So that our global asset is high yield, is what you're saying?
Yeah, in the past year, it's been high yield. Global bonds, especially because we saw negative real yields and very low sovereign yields, we switched any clients that had a global bond target, we switched them to high yield just to take advantage of dislocations in the high yield market. But I would say before March of last year, you would have had global bonds in your portfolio. Today, it's just high yield. That was a tactical switch as well.
Would there be any fees associated with switching to the different bond markets?
No, there isn't. We don't charge any transaction fees. And also we're an institutional manager, so there are no embedded MERs. So you can be assured that, if we switch you from one strategy to the other, it's not because of a benefit to us. It's purely for your own best interest.
Okay.
Okay, any more questions on this part? If not, we'll move to the second part of the change, proposed change, which I think is the more contentious one here. So Leila, I'll let you explain about the move into the real estate 10% there.
Sure. Okay, great. So just by way of background, our real estate strategy came about in November of 2019. And RBC has wanted to provide a real estate strategy to most of its clients. We never did that because real estate is a very specific asset class and it requires very specialized skill set in managing because you're managing real assets. You're taking care of building maintenance and managing tenants and rent rosters and all that stuff. And that's not something that we do as a bank. But in early 2019, we had the opportunity to create a joint venture with British Columbia Investment Management Corporation. So BCIMC, as it's known, has its own real estate arm. It's called QuadReal. And in fact, pretty much most large Canadian public pension plans have their own real estate arms. So OMERS, which you might know, had Oxford Properties. Cadillac Fairview is the arm of CPPIB. You have Ivanhoe Cambridge is the real estate arm of Teachers Pension Plan of Ontario. So there is pretty much all the big public pension plans have dedicated real estate arms. BCIMC was one of the few pension plans that didn't have a lot of global real estate footprint, and they wanted to diversify their real estate footprint globally. And in order to do that, they did sell some of their properties in Canada to raise cash for that. But then they had a portfolio, sort of the crown jewel buildings, if you will, of about 40 48 properties, I'm sorry. And that portfolio, they decided to strike a joint venture with RBC to give RBC clients a 50% ownership interest in that portfolio. And by doing that, they were able to effectively monetize 50% of that portfolio. So they didn't have to sell. They were able to monetize 50% of the portfolio and then turn around and spend the funds on getting a global real estate footprint. And this was a win-win for them and for us. So they obviously got their global real estate footprint. We obviously were able to offer our clients a real estate portfolio that is actually quite unique. It's the only instance in Canada that this has been done, where our clients or any investors, any individual or institutional investors are offered a share of what is a really institutional real estate portfolio. And the benefit to our clients is that, it's a portfolio that's there. These 48 buildings have been around for a long time. There is data on rent rosters and how these buildings have been maintained and what their valuations are. So it's not greenfield or brownfield where we're, doing capital calls and building these buildings and might get into construction headaches. And there's none of that. So the portfolio is there. It's 48 buildings, and over 4 tranches, RBC clients are being given access to the portfolio. So the other benefit to our clients is that, so from day one, so when you make a commitment to the portfolio, from day one, you're fully invested. Again, there are no capital calls. So from day one, you get exposure to the portfolio growth and to the cash flow yield of the portfolio. Cash flow yield is between 3 to 4%. Right now, it's about 3.2. I have all the numbers in the presentation. I'll bring them up as much as I can. Maybe I'll put it on this page, on page 19, where it talks about the assets there are now 50 assets in the portfolio, and a total of $8 billion gross asset value, of which RBC clients, by the time all the tranches are funded, are going to have a $4 billion share. The terms of the partnership are such that BCIMC has to be our partner. Never say forever, but forever. And in fact, that was the term. That was the requirement, because again, we're not in the business of managing real estate. We can't do this without having a partner that is actually in the business, and that's why BCIMC, shoulder to shoulder, they're going to be our partner in this joint venture going forward, with no chance for terminating that partnership. And the other benefit for our clients is that they are able to get access to assets that have historically in Canada been the purview of institutional of institutions. So most grade A office buildings, commercial real estate in Canada, or residential real estate, not single homes but rental apartment buildings, have been the purview of institutions, because we have such a large pension plan sector. Generally, these types of assets have been within their portfolios and not accessible for your average investor or your average private or institutional investor. So this is a great opportunity for our clients to access that. In terms of, so I've talked a lot about the good parts of that. Obviously, COVID was a difficult period for real estate, and our fund actually did hold up quite nicely. You can see on page 20 at the bottom of the page, net operating income in 2020 was actually 90% or 94% of our pre-COVID budget, which is telling a lot when you consider the state of retail and the food service business. And year to date, 2021, net operating income has outperformed our budget by about 11%. Cash flow was strong, 100% of pre-COVID budget, and again, it's because there are a lot of long-term leases in the portfolio, and it is expected that leases would be paid even if people are not showing up to the office. Occupancy remains strong. In Q1 of 20, it was 95%. By Q2 of 2021, it's 94%. Slight downtick, but a lot of that is because on the residential sector, we didn't have the influx of immigrants and foreign students, which are the big sort of customer base for the professionally managed residential rental apartment buildings. And rent collections remain strong, never been below 90%. In Q1 of 21, they were 95%. In Q2 of 21, they were 97%. So again, very strong metrics considering the upheaval that COVID has caused in the real estate sector. Maybe I'll just go, actually on page 21, just to give you an idea of the geographic. So it's all Canada, and the geographic breakdown really prioritizes areas of the country where we have strong and diverse economic base. So Toronto, Ottawa, Montreal are those areas. And then you can see Vancouver, Victoria, that's sort of the second largest representation. And then you see Calgary, Edmonton, and other. And in terms of property breakdown, so right now office has more allocation to the portfolio than it will once all the tranches are funded. In fact, on page 22, you can see the target for the office segment. If you look at the pie chart on the left-hand side, the target for the office segment is between 40 to 50%. Right now at 53%, we're over that target, but it's just because of the way tranches are funded. Once all the tranches are funded and the portfolio is closed, we expect office to fall between the 40 to 50%. And conversely, we expect share of industrial to increase, share of retail to reduce, et cetera, et cetera. So with that, I've talked a lot about the good things of the portfolio. Maybe I'll just talk about a few considerations that I think are important. The first one's fees. So any portion of the portfolio that's invested in real estate would incur a fee premium. And the fee premium is 60 basis points. So what that means is for the 10% allocation that we have recommended to you, your fees will go up by 6 basis points. So I want to be very clear, your fees don't go up by 60 basis points, they go up by 6 basis points. That means that your fees currently are 60 basis points, so they would go up to 66 basis points if you made that 10% allocation to real estate. That's the first thing to note. The second thing to note is that this is not a very liquid fund. It opens on a quarterly basis, so you can trade quarterly, but it doesn't trade daily, and I don't think that's surprising to anyone. Most alternative strategies don't trade daily. And the last thing to note is we don't recommend our clients invest in real estate if they have any intention to withdraw any funds from it in the first 5 years from investment. And the reason for that is, like any other real estate transaction, you have to stay in it to actually get the benefits. And it's the same as if you sell your own house. You probably, if you buy your house today, you probably don't want to turn around and sell it next year because the transactional costs present a lot of friction. And that's the same thing. And in fact, for clients that withdraw within the first 5 years, the last line shows there is an early redemption discount to the net asset value. It's effectively a redemption penalty that is sliding scale. So if you withdraw within the first year from purchasing, it's 5%. On year 6, it's 0. And it's really to discourage early redemptions. And to be very clear, it's not a fee that goes to RBC. So the early redemption penalty actually stays in the pool to make all the unit holders whole for the transaction costs related to that early redemption. So we don't pocket that fee. And last but not least, just in terms of the overall benefit to the portfolio, and I can show you a slide deck of 50 slides on the strategy, but in the interest of time, I'll just talk about it very quickly. The target total return for the strategy is between 6 to 8%, of which it is estimated 3 to 4% is going to be a cash yield. And there was one more thing I was going to say that slipped my mind. There was a target total return. Oh yeah, and in terms of adding it to the portfolio, the benefit to our clients' portfolio is that you get effectively a higher yield than fixed income with a similar volatility level. So that's why we're talking to a lot of our clients to just reduce their fixed income exposure and allocate some of it to real estate, simply because you're not giving up on yield. And you're in fact increasing your yield without materially increasing portfolio volatility. So I've spoken a lot, and maybe I'll give the committee some time to ask some questions.
Okay, so just so we're clear on this, I know Sandy has sent some questions in, and he talked about the adding to the mortgage fund, but just to be clear, this is not mortgages. This is actually like a real estate income where we're going to be collecting rents.
Yes, exactly. It's very different from the mortgage fund.
Because that was one of Sandy's, I know he's got a series of questions here about, wondering if holding mortgages was more conservative or not. And of course, worried about post-COVID, if vacancy rates are going to decrease, either commercial or your institutional vacancy rates. But Leila, you did speak to that a bit. You think that's going to, even if people are working from home, rents will still be paid, and you're not expecting a wholesale defection from the commercial real estate?
So no, so it's a few interesting data points. So first of all, demand for industrial has increased. We saw a rent growth of almost 10% from the industrial segment last year. And a lot of that has to do with logistics related to online shipping. So as retail has gone down, we've seen industrial go up because of warehousing, etc. So industrial segment certainly on the up and up. On the office segment, when COVID hit last year in midsummer, we saw a lot of subleases being put on the market, and a lot of them are now being pulled off the market. And in fact, in our portfolio, we've signed a couple of leases, new leases for tech companies, specifically for office space. So a lot of companies are realizing you can't, you do need an office footprint, and it might be that you don't need as much office footprint as you previously thought you did. But the good thing is actually in Toronto and Vancouver, there was a real estate shortage for office space. So that has kept the price of office real estate in Toronto and Vancouver quite elevated. So I would say, based on what our portfolio manager has seen, even if companies don't expand their footprint, maintaining the current footprint, which I know we are going to do, is going to maintain status quo. Where we've seen decline in occupancy and rents has been in the residential segment. As I said, it really targets foreign students and immigrants, both of whom there were not that many coming into the country last year. So we expect to see that reverse. So we fully expect that to be a short-term effect.
Okay, thanks. Other questions and comments? Anyone have anything else at this point? Sorry, Christine, go ahead.
I'm not trying to influence any choice here, but as Leila was speaking, it struck me that this move to real estate is not too unlike the discussion that the committee had several years ago in, I think it was Tony that actually broached it, about why not keep land as an asset class, right? This real estate pool is a different kind of asset in our long-term portfolio. And we did discuss simply holding some of the land that we already have, or holding the land and renting it out. And we talked about the houses that we have, the rental houses. And so by making the choice to disband the house rental business, are we now just moving into a different kind of land asset building investment? It just struck me as she was speaking, because over there we're dropping houses, and over here we're investing in office buildings or commercial real estate.
Just a reminder, we're in open session.
Okay.
Okay. There's certainly, it's a different, it's the same idea. You're right, Christine.
In a sense.
Different geography.
Different geography.
And it's not just us. It's obviously we'll be in a fund with other investors, and we've got RBC and their partners out there in BC that will be managing this. But yeah, interesting about whether we want to be invested in real estate. Brian, go ahead.
Yeah, so could you explain the different tranches and how that works? Right now it's tranche 3, so there was 2 tranches before this. How does that work with the investment? What happens? So we'd be investing in tranche 3, I take it, and if we did this, and then later they'd open tranche 4 and 5 by the looks of it.
So I don't know that there's going to be a tranche 5, because there was a demand in tranche 1 was quite high, so they increased the allocation into tranche 1. Which means that we're probably not going to go beyond tranche 4. So the way this works is you actually, every time you invest in a tranche, you get exposure to all of the buildings. So the tranches are just a means for you to go in slowly, or just you can put in as much as you want in one tranche and you would get exposure to all the buildings. So at each tranche, the way this works is you get a specific exposure. So for example, in tranche 1, clients got exposed full 50% exposure to 10 buildings, and then they got 5% exposure to the rest of the portfolio. And then in tranche 2, the funds that came in increased the 50% exposure, which is the maximum exposure you can have to a building, from say 3 to 8, and then you got, you know, the 5% exposure went up to 10%, et cetera, et cetera. So it just, you gradually buy a higher share of the portfolio. You can think of it that way. So if you go into tranche 3, you will get whatever exposure it is that I don't know it by heart, I'm sorry, but you would get, call it 20% exposure. 20 buildings, you would have full 50% exposure. And then for the other 20, you would have somewhere between 10 to 5%. As you go into tranche 4, even if you don't invest in tranche 4, effectively the funds that come in allow all the portfolio holders to gain full 50% exposure, assuming tranche 4 is the last tranche. The funds that come in allow all unit holders to get full exposure to 50% exposure to all the buildings. So I guess you could think of it as being diluted. So if you don't put more money in tranche 4, your holding in tranche 3 gets diluted so that everybody gets the 50% exposure. That's how it works.
Okay,
But
so that's
ultimately,
that's how they're funding the portfolio. Is every time there's a new tranche open up, there's more funding, so they can buy a higher share in the assets.
Precisely.
Okay,
Yeah.
I got it. Okay. Of course, the more investors there are, the more diluted it gets because there's only so many assets to have.
Yeah, I think that's a fair way of putting it. Absolutely.
Any other questions or comments? I know that recently there was a bit of pushback, certainly in the media. They were worried about some of these companies coming in and talking about buying basically single family homes. And there was some concern about people not being able to afford to buy their own home and having to be renters.
That doesn't,
Yeah,
so that's not.
This isn't going into that. This already has about 50 buildings and they're all, looks like
It's
they're all.
Yeah, there's no single housing. There's no plans to have any single housing. Single housing is a whole different beast. And, you know, so this is all anything that's residential is multi-residential, professionally managed apartment buildings. You know, single housing can be quite risky, I think. It's for you to manage on the side, to be honest.
Yep, okay.
For our type of client.
Just wanted to flag that, so that's good, thanks.
Mhm.
Anybody else in the committee have any comments or questions at this point? I'm not seeing or hearing anything. So if there's nothing else right now, certainly Leah, I'd like to thank you for your presentation today. And
Thank you.
Thank you to Jacinta as well. Nice to meet you.
Of course. Thank you. Nice to
And
meet you. Oh.
we'll certainly given us a bit to discuss here, and I know we'll keep in touch and we'll see where we go. But yeah, certainly appreciate all the work you've done for us thus far, and things have gone quite well. So we're quite pleased with the way things have been happening.
Thank you for the kind words. Yes, please let me know once the decision's made, and have a great day.
Sorry, just before we go, there was a question also from Sandy about, I just have to find it here, about the recommendation. Sorry, I will find it so I get it right here. Nope, I just went back to the same page. Okay, sorry. It says Lelia recommended increasing the weight of our global holdings. I would like someone to ask her, does this create currency risk? Does it create currency risk by doing that?
So actually, if the committee decides that they want to go with a real estate recommendation, we would keep your global holdings as is. So we wouldn't increase them. Okay. If the committee decides that they don't want to add to real estate, then what we would do, if you decide you don't want to add to real estate, but you're okay to reduce 5% from Canadian equities, then we would put that 5% in global equities. And no, I mean, with the global equities, there is currency risk with global equities, absolutely, in your portfolio. However, for Canadian investors, the currency risk tends to work to their benefit most of the time. because in periods of global economic markets, markets decline because of declining economic conditions, our dollar weakens. So you definitely want to be unhedged. You would benefit from getting that global market exposure. But conversely, if our economy is doing really well and then our dollar strengthened, you would certainly see less returns from global markets. But I would say on balance, historically for Canadian investors, it's paid off to be unhedged. And that's why we don't really, we don't have a view on that. It's not material in the long term.
Okay, thank you.
Okay, that's good. If there's no other questions or comments, then again, thank you, Leila. And Jacinta.
Thank you.
Thank you. Have a great
Thank
day.
you. All right, so I don't know how everybody feel about this, if they want some time to digest it, if we want to discuss this at a future meeting, when Sandy can join us as well. I don't know if we have to worry about the time if we don't decide not to do anything right now, if we don't get in the third tranche, so that we have a little bit of time before we would invest in the fourth one. Or we may decide not to do that part of the plan. We may only want to go with the other part, or we could decide to not change anything. So any thoughts or comments from committee members?
I would definitely like to just digest what we heard today and wait. And I'm sure Sandy will watch the live feed and join us at our next meeting. And I'd like to definitely hear his opinion on the matter before we make a recommendation to the board.
Any other comments?
Yes, can I, through you?
Yeah, go ahead,
Alan,
Anne Marie.
I'm quite comfortable with what I heard myself, but I would concur with Brian if the rest of the committee feels more comfortable to have Sandy on board as well. That's good. I just want to reiterate, I'm quite comfortable with what she suggested.
Okay, good, thanks. You have any questions or comments, Jim?
I'd like to take more time to sort of look into this, the real estate piece to this. And I agree with Brian that, and Sandy has got some very detailed questions, and I think obviously a lot of knowledge behind these questions that I would like to hear from at a future meeting.
Okay. Christine, do you have any thoughts or comments at all?
No, I don't think there's any major panic to make a choice either way. So bringing it up next month at a next month meeting would be fine.
Okay.
If you want to digest it.
So yeah, we are planning a meeting in a month's time, if I'm not mistaken.
Mm-hmm.
Yeah. Okay. Well, it sounds like there's no problem with waiting then, and we can get some more time to read through this. I know the presentation, when I first read through the slide deck, there was a lot of questions, and as she did the presentation, you understand it more, but it's a lot of material to digest. And as Brian said, I'm sure Sandy will watch it and that will answer some of his questions, but he may very well have some that aren't answered and some new ones. So
and I guess we have some thinking to do about where we want the fund, our allocations and stuff to go in their fund. So make sure it aligns with our principles and make sure it aligns with our goals.
Yeah.
Just one of the things that struck me was the cash component that she spoke about in both the real estate fund and one other I made a note on for the future, because there may be a desire to or need to secure more cash from this long-term portfolio. It's a possibility.
Mm-hmm.
That's all.
Yeah, it's only a portion we would, if we put this real estate, it's only a portion, but still,
Mhm.
that's the portion you wouldn't want to touch for 5 years.
But it could generate cash for us.
Yes,
And our other shorter term holdings are getting 0.4% a year,
right, okay.
which is not anywhere near the rate of inflation currently.
No, we've,
Yeah.
Now, they always say cash is the worst thing to have for an investment.
Right. Well, right. So we would use the cash. We would use it to supplement, right?
yeah.
So are you saying
Alright.
that the real estate investment would pay us essentially a dividend, a measured cash flow every year, or would it be reinvested in the fund?
Well, it could pay us a dividend. It generates cash. So it could pay us a dividend, and we would still have what we invested held in there. So I think this is why she's suggesting this in lieu of some of the bonds, right? Because the bonds pay interest, but the yields on bonds have been traditionally very low. This would be a way to increase the return in the portfolio.
I would say that makes me happier than investing. Having the cash flow of basically being the landlord and having the cash flow come in, it makes me happier than investing in real estate just to see to speculate in it, to see if it goes up as the current housing market does.
Right.
But because obviously you don't have that. Traditionally, if you look at inflation, everything, housing market is a horrible investment. People just sell their house once every 30 years. And so they get stuck in the thing of, oh my God, it went up that much. But traditionally, now the last couple of years has been an anomaly, but which might correct. But traditionally, if you look at over time, especially with maintenance costs and everything put it in, a house is a horrible investment. Traditional real estate. This is a different real estate of what I was thinking it was. Again, I was with Sandy's thinking that it was more of a same as our holding mortgages and waiting for just the interest paid off the mortgage. This is actually revenue generating. You're getting to partake in the actual income from the property, which is something to think about. But there's risk as well. The economy is booming and booming. And of course, it's going to go on forever, but that could change in a heartbeat. We all know that. So, and where would that leave us in this fund or anything like that? Because again, I'm sure they're great to tout the benefits of getting that cash flow, but if the cash flow stops, it also stops for us.
Mm-hmm.
There's risks involved there.
Yeah, true enough. All right, any other questions or comments? If no one has anything else done for today, that just leaves us with the item number 6, which is adjournment. Nothing, I don't think we've forgotten to do anything, have we, Christine? We're all good?
Do we need to receive her presentation?
We certainly could have a motion to receive it as information. Yeah, absolutely.
I'll make that motion.
Ryan, want to move that? Somebody like to second that?
Sure, Anna Marie.
Anna Marie, okay. So there's no comments or questions then on that motion. Michelle, can you do the roll, please?
Alan Dale,
Yes.
Anna Marie Murray,
Yes.
Brian Petrie,
Yes.
Jim Reffel.
Yes.
All right, that's carried. Thank you very much. So yeah, that takes care of item number 4. We dealt with item number 5. So yeah, item number 6 is adjournment. Would someone like to make a motion to adjourn, please?
I move to adjourn.
Jim, okay. Thank you very much. All right. Thanks, folks. Lots of information there to read. I know I'll be going back and reviewing some of the stuff again because after a while it starts to, the more you think you know, the more you think of things that you don't know. So, but yeah, lots there. So thank you. Enjoy the rest of the day and we'll talk soon.
Thank you.
Thanks,
You too.
everybody.
Bye-bye.
Everyone.
Bye for now.